We see them going at 2% by the end of the year. That's for the forecast. It could very well be that we have a spike well above that number in the second quarter. Remember that in the second quarter, a lot of these recovery/reflation factors will come to an end. We'll get widespread reopening of the economy. We get strong retail sales on the back of the fiscal stimulus. The vaccination campaign would have got basically vaccinated the vast majority of the population. So this is when all these factors will contribute and then conspire towards optimism in the market and towards that spike in US Treasury. So at the minimum, I would say 2%.
And Antoine, what does all this mean for European yields? Because it feels like treasuries have really been the anchor for core rates around the world. So what does a 2% 10-year mean for European yields?
Yeah, it's a very interesting story because fundamental, by and large, the fundamentals behind that rise in dollar rates are not present in the Eurozone. The contagion from dollar rates to euro rates is through the risk premium. In other words, how do investors assess the risk of their bond holdings? And this is very correlated between euro and the US. To answer very simply, we will see more upside to euro rates. There isn't a very strong fundamental reason for it, but we do think the 10-year bond will end the year at 0%, which is about 30 basis points higher than now. We really don't make that call lightly. Our long-term view on the Eurozone is that it will fail to, by and large, to reach that escape velocity that would allow the ECB to unwind its QE portfolio before long to hike rates. This is a lot longer away compared to the Fed, and yet that rise in risk premium across bond market is a global phenomenon and will continue pushing yields higher even in the Eurozone.
Should the ECB be doing more to counter the rise in yields? Many people are disappointed that the pace of the PEP program for the last week came in much lower than expectations and much lower than average. They've said that that's on back of some redemptions, but I mean, theoretically, the ECB could be doing more if they wanted to.
Yes. So starting with the purchases, clearly there is no strong signal in the data that we've seen so far. If the ECB was if there was either a consensus at the ECB on what to do, or if there's a genuine concern about this level of rates, we would have seen higher purchases. Clearly, they have the possibility to do it. They have the firepower and they have the credibility. So the message here is that no consensus clearly on what to do. Perhaps it will change when rates are higher, but at the moment, that's not the case. And this is also a good reflection of what we think is going to come out of the meeting tomorrow, which is mostly words, some general verbal intervention, but no announcement of new policy steps.